Hello, folks. Welcome to State of the Market. This is David Russell, Global Head of Market Strategy at TradeStation Group. It's great to be with everyone today. It's Monday, February 9th, 2026. And today we're talking about how value surges as growth sputters. And this is a continuation of a theme we've been discussing for several weeks now. And to a certain extent, we might very much have confirmation that we've kind of entered a new kind of market, a more substantial shift away from the high multiple growth stocks. We've been talking about this, and in many ways, there's different ways to think about it. It's not just in many ways to be thought of as a shift away from technology or anything like that. In many ways, it's a shift, it seems to be, away from the kind of stocks that we would call long duration growth stocks that were very common. So I'm also just very quickly put up here that on Thursday, February 26th, 2026, just a few weeks from now, we will be in Florida, in Plantation, Florida, which is near Fort Lauderdale, for our masterclass, Derivatives in Focus. I'll be speaking with some of these gentlemen, some other people like that. If you guys are interested in attending, you can use this QR code right here to get your 20% discount, and hopefully I will see you then. So I'm going to just quickly show the standardized returns of some of the ETFs that we're going to be looking at. And like I said, in many ways, we're really in a situation now where this seems to be a more substantial period of rotation, and that's really the way to think about it. Everyone likes to talk about news stories and earnings and all this sort of stuff, but ultimately the market has money shifting around for different reasons, and the reasons don't just react to a single news event. These are based on long-term flows and long-term views of different kinds of assets, different kinds of industries, and these shifts come every 5 to 10 years. You see something substantial, and we now seem to be at the point when it's pretty hard to deny that something substantial has changed. And one of the ways I'll highlight to you, if we look on this workspace here, we look basically, first of all, on a year-to-date basis, we can see very clearly energy, materials, consumer staples, industrials are leading. Lagging are consumer discretionaries, financials are lagging, but then also communications and tech. So it's interesting to look at the numbers here. The S&P is up 2% year to date, and these things are down 1 to 2%. And this 1 to 2% that the big names like tech and consumer discretionaries are down are more or less erasing double-digit gains by these smaller sectors. And I think that's an important thing to realize here. Another way to look at this, we have an indicator here called days since 52-week high or low. If you look, you can see that technology stocks have not made a new 52-week high in 69 days, but energy, industrials, consumer discretionary, consumer staples, and materials are all there. Now, communications made a new high, but it didn't hold. But I think the key thing here is that we are now seeing energy, industrials, and materials. That is where the leadership is. And at this point, I think it's pretty kind of well established. These are value sectors to a certain extent. They're cyclically exposed. But what's also very interesting is if you look inside of technology, you can see certain stocks like Cisco Systems. Some of these semiconductor stocks are doing well. And then you look inside of other areas, it's interesting to look inside of industrials. You have certain stocks like Verisk Systems, which are basically a long duration sort of intellectual property stock doing poorly. You can also see that within certain things like casual dining, Chipotle always kind of traded as a tech stock. Other kind of some of the other technology fintech companies like SoFi and things are struggling because they traded long term. Like we look at some of these, like SoFi or something. These stocks traded like tech stocks, not like financials. They traded at high multiples. They had disruptive platforms. That was the narrative. And so what's really happening is not just weakness in technology, because you do have things like Cisco going up. We did a trading view idea on Intel. These are not, it's not about the sector. It's really about long duration, which was so strong for, a decade, which is now in many ways not working, and people are moving to kind of everything else. And it's something of a shift of value, but not just a shift of value. It's heavily seen as a shift away from software, but it's not just that, because you look at companies like Gartner, IT, VRSK, which is technically an industrial. That's not what it's about. So I want to just kind of point that out. All right, now you want me to go here to tradestation.com. go to Insights, Market Insights, and you can actually see the blog post we did today as an airplane taking off. Because believe it or not, airlines were the best performing industry group last week. Now, of course, as an industry group, they are inside of um, industrials. We also, we're talking some time back about the breakout in transportation stocks, and of course, they are transportation stocks. So it's important to kind of realize. Um, Now, another thing here I think is important to realize is part of the long duration trade that we saw was in many ways a period of American exceptionalism, as people said, domestic stocks outperforming. Part of this thing now is what we're seeing is global stocks are outperforming, but it's not just about global stocks. It's about the fact that a lot of global stocks trade at much lower multiples. So it's not just a global story. It's really a story about value and getting away from long duration, high multiple stocks. Like, I mean, Palantir is an example of a company now that, people moving away from things like Shopify, things like that. So I want to just emphasize that to really kind of highlight, what seems to be kind of happening here. I'll also point out if you want to just Google TradeStation, why do stocks move? You'll find this article from September 21st. But I would really emphasize this because, you know, as someone who's looked at markets now for I can't believe it was 25 years I've been doing this. I believe that there are essentially seven narratives or mechanisms of why stocks go up or down. And the one I really want to point out here is investor rotation. You get into these periods of time when people flock to one thing and then they flock to another thing. And right now we're in the period where people are flocking away from large cap growth toward global, toward industrials, toward mid caps, which I'm going to mention in a second, but mid caps, small caps, banks, people are flocking out of the large names and into these other areas. And I think that's really important to kind of realize. Um, some of these items along the way, like this geopolitical news and the tariff stuff that might give it a bump along the way. But what's really happening now is that you basically had a massive concentration in high multiple, long duration growth stocks, really for like a 5 to 10 year period. And now it's finally coming unglued. And that's basically what's happening. And overthinking it and pegging it to events or news, I think, is a mistake. It's really a question of understanding we're in a period of investor rotation. These things happen from time to time. And the fact we're in a new year makes it even more likely that this would be the case. So um, it's also interesting we're in a period that's increasingly dovish for the Fed, and we're going to get to that in a second. So I want to also point out a few of the ways to think about this. Look at how, like, for example, when silver started moving, you got this kind of explosive move. Look what happened when Micron started moving. You got this kind of from back here this explosive move. SanDisk, same thing. You could say the same when it started moving, or look at something like Seagate, same sort of thing. When it breaks out, it really runs. So I have an unusual MACD. I'm going to explain that in a second. But the key thing is it you have these things that are like kind of corked up tight, and then there are many ways the breakout was really here in like Seagate. But the key point is, and I think there's a way to think about it. Seagate is a relatively small company compared to something like Nvidia. So the thing is that there's so much money in these names like Nvidia, Microsoft, Broadcom, Meta, Apple that if 3 or 4% of that capital leaves, it can have a big impact on these smaller companies. So what in many ways I believe we've been seeing for the last 3 to 4 months is we've been seeing money a little bit comes out of of Nvidia and it goes to Micron. A little bit comes out of Nvidia and it goes to silver. And I think that what we're seeing is we are seeing these small individual explosive moves in certain niches of the market. And I think right now we have to realize that the Russell might be the next thing to go. So I want to just emphasize that. That's to me, I think what's most interesting here is that we might actually be at this period of time of Lucy and the football, basically just having these failed breakouts in the Russell for literally 5 years now. There are maybe some reasons now to think that this time it might actually be confirmed. And I'm watching to see if the Russell has that potential to extend the same way that we were seeing in some of these others. And I would just point out that some of the things like, and we talked about the banks, but I mean, the banks are really running here. And this is something I think we look at this, the KBE banking index has broken out. Now, a lot of the small caps are the banks. So we are seeing this in value and in mid caps and the parts of the market that are not very, popular. But this is where the strength is right now. So, and we talked about materials. It's very much happening in materials. So, if you look at my article, I really kind of highlight these 3 points here. The big three, as I call them: communications, consumer discretionary, and technology. I mean, these companies, if you did the math, you looked at them, the market cap of these companies dwarfs other industries in a lot of ways. And this is what's holding back the market. So, I would just kind of emphasize, I think it's important to realize these kind of big names. For a long time, people complained about how it was a risk to the market, these kind of companies struggling. And in many ways now, that thing people have worried about for a long time is panning out, but it's not turning into a risk. It's turning into opportunities for those areas that are attracting some of that capital that leaves the big ones. So, as we look at some of this, I want to point out we did a trading view idea on two stocks in particular that are interesting, but are Boeing and Intel. Boeing and Intel, these are both Dow members. The Dow last week broke out. And I mean, I think Boeing here is potentially interesting if we really look at Boeing. I mean, Boeing had all these issues with their safety and stuff. But if you look at the stock on the long term, it's really been kind of struggling here. But I mean, this is really something where people might see the real potential when we start getting above like 250 for this to potentially have some significant upside. This is a very important level. If you actually look here, this level that where it bounced, if you go back, this was when I think the part of the fuselage blew open, and the airplane was like, there's that crazy video when you can see like the open sky or something through the side of the airplane. But that was back here in January of 2024, this level around 230. And now look at where we basically held. So this to me is a very important sort of area. You can see we came up to that 230 level and we failed. And now we come up and we hold. This to me, I think, is one people kind of look at. Remember the Dow, it's an industrial. Industrials breaking out. That's what I'm talking about. And then Intel. I mean, Intel here is also, we've talked about how, Intel on a price to sales, price to book trades at a huge discount relative to the bigger names. And, they're in the process of trying to get their new manufacturing working. I mean, if they succeed, people could see some upside on this. And this thing's really been moving if you look at this stock. I mean, this has been something of an explosive move from here. We did a trading view idea right here. And then we did another trading view idea just today over here. But I think you can check out these trading view ideas and kind of see what we're talking about. So that's important. And then, long duration. Well, the thing is that people might be thinking now, when Palantir gets back up to 150, people might be thinking about something like selling credit spreads on it. When Oracle kind of claws its way back up toward 175, 180 in this range. So I think people want to just be kind of thinking about that. These things now are at a spot where these are not just normal pullbacks. In many ways, these are things people might view as being more structural and lasting. And I think it's important to realize that this is the kind of trend of where we are now. These are very high multiple stocks. There's all these questions about their cash flow and all this sort of all these issues with them investing too much or trading high multiples and things like that. And I think right now that for the time being, the market has kind of honed in. The price action is honing in on other areas where people are seeing opportunity. And I think things like this, people might be thinking the other way, and people might want to be thinking about, what are the kind of option strategies can be utilized when names like this push back up toward resistance levels with this kind of structural weakness. People might look for, longer lasting neutrality in these names, which means that as they get up toward resistance levels, there could be opportunities to be selling the upside in them. That's, I think, another trend that's maybe kind of emerging. Now look at the Fed. Now this is the CME Fed Watch tool. Let's go to June because some interesting things have kind of happened in the last week or so. We've basically gone from, um, you know, basically a 97% odds of one cut or no cut to now basically a 70% chance of of um, of at least one cut. So, I mean, it's interesting that what you see here, I always like to look at this because you can kind of see how things move, and you can see now there's a much bigger chance of two cuts, and the chance of one cut hasn't really changed. It went from 47% to 50%, but the chance of two cuts, basically doubled. So you see now there's much less chance of there being no cuts in June. So I want to just point that out because I think the market is looking out and it's seeing a scenario that is potentially more dovish, and that could be potentially a positive for things like banks and things like that. The nirvana environment for small caps are rate cuts, and that's what the market seems to be seeing here. I think it's important to realize. And if you look last week, we had higher than expected jobless claims. We had the layoffs from Challenger Gray that was at like the highest number in a while. We had the ADP private sector was weak. We had JOLTS weak in terms of job openings. So we're looking at a weaker job environment. I actually saw a few articles in Bank of America said that it was someone, there was at least one article on CNBC or something that was really saying that the job market is weakening. I noticed that after I kind of was looking at this stuff, but to me, I think that we're now getting in that environment where the dovish narrative is coming together more clearly. And I think the next thing now to look at is that the dollar is, I think, an opportunity people might be looking to the downside. I'm going to get to that in a second. But we had the Japanese yen rallying after some election news over there. We've been talking about the Australian dollar, and from my view, this is one that remains an extremely um, interesting currency to look at. It has futures on it. We did a webinar not that long ago about currency futures, and I think we want to put this on people's radar. This has an association with look at this level on this thing. We don't normally look at the currencies that much here, but I just want to point out that to me, this is very interesting, and this has a long-term historical correlation to commodities going up. So I think when you look at the dollar, the Aussie over the long run here, this might be something where people see on the weekly chart. I mean, this thing has a lot of space that people might see to the upside here now that it's broken. And if we enter a period of more sustained dollar weakness, this might be something people see some substantial upside potential. So I think we want to keep this on our radar. Um, and I would just say it's not just the idea of like people that sell America and things like that. It's about the fact that for a long time the global markets underperform relative to their valuations and things like that, and now things are just kind of catching up. I wouldn't give too much emphasis on the political aspect of it. Just the fact that we're in a spot now where we're getting closer potentially, to the Fed cutting, and other people are not, and our valuations are high. Other people are not, and that's what people are focused on. So from my view overall, the S&P, I was just mentioned that look at the S&P. From my view, is the S&P on the daily here. You see these kind of weak highs, and I think from my view, as long as we kind of hold, 6,800 to 7,000, people will go to work in other areas. That's really the way to think about this, and they are going to work in other areas. I think we emphasize this level here in the advanced decline line making new highs, and that's lots of small stocks hitting new highs as the big names limp, as we've been saying. And I think that's the key thing to think about. In an environment that is a weak dollar environment or a kind of small cap environment, what you'll see is the S&P will just drift. It won't be bearish. It'll just drift and be slightly neutrally bullish. And then other stuff goes like much more aggressively bullish. And that's what we're seeing when you look at some of these other things like global stocks or the small caps or things like that. So I think that's the perspective to have here, that as long as the S&P doesn't break down, it gives people permission to go out and to risk up in these other areas. I talked about these and close this. I don't have too many things open. So check out this article. Why do stocks move? I mean, to me, I think this is a way to think about things that is relatively simple, and it can be very useful. It's kind of like understanding, when you're just thinking about a big picture thing, like if you're buying a house, how many beds you need, how many baths you need. You start at these high level things and work down. And I think in many ways, the way to think about this, you start at a high level thing of why is the market moving now? There was a time when it was moving based on volumes because things were ramping up in terms of more chips sold and all that stuff. But right now, we're moving, I think, in many ways based on investor rotation. And that to me, I think is, an important thing to realize because that can remain in effect even when news items go against it. If we have like a hot, number that makes people think the Fed is going to be hawkish, that's something that may not last for long because we're in a period of rotation. And I will just mention we have payrolls on Wednesday because of the government shutdown that pushed things around, and we have CPI on Friday. So we have this kind of continue to be kind of messed up economic schedule. So just realize those as the catalyst. So now we turn to the overall, weekly charts as we always do. And like I said here, I mean, we've drawn lines at different places, but in my view, it's essentially 7,000 to 6,800 or 6,790, which was an important close at one point in time, 6,790. I think overall, like I said, the key thing is that it's not breaking down. It's tried to break down and it comes shooting back. So it shows that there's not a lot of desire for this thing to break much lower. What's also interesting, if you look at some of these surveys from things like the National Association of Active Investment Managers, they publish something NAIM. the American Association of Individual Investors. Both of them have shown things getting more bearish recently, and that's a contrary indicator. So it does actually suggest here that people have not been piling in too much into things like into the market. They've been scared recently, and I think that actually does give some potential for there to be, kind of more buying power. Think about it like that. Um, so the S&P here, I did mention that the advanced decline line over here, which I think is kind of just kind of tells the real story of what's happening. I mean, this dramatic advanced decline line doing actually the breadth has been very strong. Now, look at the Qs. The Qs here, we talked a lot about how the Qs are still below where they were in October, and the end of October, and I think this is a huge story. The fact is, this has not broken out to new highs. This was a day when Nvidia hit 5 trillion. It was back here. We've been talking about it for months now, and it remains the case. So I think right here, it's just a spot where it's stuck, and people might just kind of see, a day or two. It has, big weakness and come snapping back, but the ability of it to put together sustained upside might be limited. Relative to other things. Now, I want to look at something on the Qs here on the daily because I occasionally do this with MACD. What you'll see I do with the MACD here is I actually increase the settings. I multiplied them all times 4. It's normally 12. Something I can't even keep the numbers straight. But if you go to MACD and you multiply all, you just quadruple everything. You get a slower MACD, all the inputs. So I think it's interesting. I've noticed that sometimes this will tell you something. You'll kind of see things just like the MACD just does this, and it just doesn't rally. And look at something like how Palantir had this very negative kind of MACD before it kind of crashed. And I think that's important. Look at things like there's another one, Shopify. We did a trading view idea on this. I mean, this MACD was even when it was just like holding up, up there, you could just see this real weakness. Now, this is something you got to be careful of putting too much emphasis on, but it does kind of tell us that these things have some kind of significant topping patterns, I think, on a lot of these kind of charts. And I would just kind of notice this also is kind of interesting. This kind of failed top here. I mean, this a little bit coming over head and shoulders, but I think it's just important to realize that when you see MACD struggling like this, now look at materials. Look at how materials here basically it didn't have a prolonged bleed to the downside. And then what is interesting is you can see how this has been ramping up at the same time technology is basically crumbling down. These conditions can remain in effect. So people, I think, have to realize this, and this is the reason why selling the upside could make sense. And we talked about this megaphone, and look, I mean, it has played out. The volatility increasing. It had this huge snapback, tested that level, went slamming down. I think this is really the way to think about it. This is now in an area where people are no longer amassing it. And I think that's what this is telling us. Other things I think to look at just very quickly, there's not much more to say. A lot of these things have broken out and they're holding, like the Dow broke out and it's holding. I do want to mention, though, the mid cap. I mean, this is not something a lot of people, look at. It's not actively traded. But if you look into some of these companies, are smaller industrial companies. And this is the moment when these mid cap industrial financials and materials, this is the kind of environment when they perform. I've seen this before, and we have not had a cycle of these kind of names doing well for a long time. And I think this is something we really need to pay attention to because the mid caps and the small caps here are the ones that are kind of breaking out. And in many ways, ironically, they kind of are similar to the Dow. So I want to emphasize that. So the Q is not doing much. From my view here, the Dow, like I said, it did have that breakout and holding, but the Russell in some ways might be the area where I'm really watching because I think when we see this pattern, like I've mentioned before, this might be something with this incredible tight sideways action sneaking to new highs here. This could be something where people look for some real extension. And it could be a thing here where, and we've seen this. You look at history, you get a period of time where for 3 to 6 months, the Nasdaq and tech goes nowhere, and then the Russell surges. There are history of it, and you can check them out. And I would just emphasize that this is something here I'm kind of watching as maybe an opportunity. Now, the TNX, the yields here are just kind of flubbering and not doing much of anything, and that's a good thing for small caps. Like I said, the economic data, not at this moment, enormously hawkish. Inflation, we're going to get it on Friday. Not that relevant, I think. I think at this point we're tilted to the weak labor market, and like I said, I think overall the underlying trends in rent and housing really have a dominance of pulling down inflation at this point in time. And I think we even see the thing with India recently. It's entirely possible that tariffs have mostly kind of occurred as a catalyst, and going forward, it could be something going the other way where tariffs maybe fade. We still haven't gotten the Supreme Court hearing. I'm not even sure when that's coming, but the Supreme Court make could make rulings. So there's things I think with tariffs where that, you know, it's been almost a year now since that whole crisis, the whole drama played out. And as we move further and further away from kind of March, April of 2025, the whole tariff inflation fear thing becomes less of an issue, and the deflation and rents become more of an issue. And we could see yields here, I think, have shown that they couldn't get above these levels from back last summer. And from my perspective, is not to say there's a ton of downside in yields, but there's probably a spot here where they're neutral to slightly lower, and that can be a very positive environment for risk and for small caps and banks. Now the dollar index here, I got to look at this on the daily chart because I mean I almost did a trading view idea on this. The number of things on this chart just kind of blow your mind. Look at the Fibonacci. I mean there are multiple signals here on the Fibonacci. So look, if we go from this high to this level, I put in the 61.8. I don't use this for stocks, but it is common for currencies. Look at these two, boom, boom. Now also look at the fact that we have here basically I'm sorry, where is it? I want this field. You can see, look at this. So you basically have kind of this low along here, and you have the 61.8 retracement. Now you also have, what's interesting is look at this. You have a double top over here. This is the daily chart of the dollar index. So we have basically a double chart, a double top failure, a slam down, 61.8% retracement failed, slam down, failed at the same level, and the low from late December. So from my perspective here, the dollar index, this has multiple signals people could be looking at for downside in the dollar, and that has implications for precious metals. It has implications for global stocks. It has implications for risk overall, and it has implications for the Aussie, which I just keep going back to, the Australian dollar, and that kind of theme to be focused on. Look at the dollar index on the weekly chart again now, and I think we can see, as I've talked about before, that once this level at 96, if this level is broken, we have space down to 90, 89, 90. I mean, there's a lot of space here. This is back, in when the market was positioning for the Fed to hike rates. This is back when Biden did that big spending bill, surge in inflation, surge in economic activity. Then the Fed was hiking rates and all that stuff through September of 2022. And basically, that whole move here, people can look for this to get filled back to the downside. So from my view here, this is something that we really need to be focused on as a big opportunity. Don't get too distracted with AI. When you have a move in the dollar and this big macro thing, that in many ways can be a pretty clear opportunity that will affect a lot of assets, metals, and a lot of other things. And I didn't want to just emphasize that because everyone's going to be talking about AI, and there's all this debate about AI, and the NASDAQ could very well just drift nowhere. And then precious metals, global stocks, foreign currencies could be the area where the movement is, and that's what we're always looking to focus on. Where's the real opportunity for traders? So XLB on the weekly here, materials. I mean, again, this looks like the Dow. Confirmed breakout now. People probably will look for modest downside to be potentially adding. And I think at this point we have a confirmed breakout. This is something also that if the dollar does move lower, this is also a small sector that could actually ramp as well. And if that were to be the case, that would also favor the Russell because these tend to correlate. XLC, communications, Google, Meta, false breakout, drifting in a range here. I think you'll have to just realize that this is just not the area where people are active right now. This false breakout, it's not overall bearish, but I mean, this creates a potential for just meaningless drifting here. And, we should not rule out the possibility that over time, this probes back down the range. And I think we have to bear that in mind and be careful here that when something is range bound, when it tries to break out and fails, the risk of it getting sucked back down that range increases. And I think here we got to realize that this was a false breakout in the communications. XLE, confirmed breakout. It's above the all-time high from back in 2014. Aside from energy prices or any risk in the Middle East, these things trades at the lowest multiple of any sector in the market. I think that's where people are focused. So XLE here, I think is something that, pretty clear, confirmed breakout here. People probably is looking to add on, modest weakness. Financials here trying to hold a level, and people might actually see this as being a thing that has now basically made a higher low. And I think that this has more of a kind of value aspect to it. So this is an area where people might be a little bit more active looking for, some kind of continuation. Industrials, as we said, this has I mean, the weekly chart on this thing was extremely tight. Had absolutely, a lot of signs of accumulation and effect, and we got that follow through. So again, at this point, I think also tight breakouts are really what people will be looking at. I mean, tight pullbacks. You just movement across here with small retracements on the daily. I think is where people are going to be focusing on, like, industrials. Just like, see how, like, today it opened down a little and then it went from red to green. That can be when things have this kind of tight breakout. 1 to 2 days down, 1 to 2 day pullback, and then continuation is where people will be active in here. XLK, on the other hand, technology. I mean, again, this thing hasn't hit a new high since it's all the way back here. We have this falling trend line. A lot of things here, I think, that also suggests that this is not necessarily bearish, but it just has this kind of stuck range. XLP, people might see this as being overdone to the upside. A lot of this was driven by um, by Walmart, but at the same time, we have to realize now that this is actually a pretty significant breakout, and this also can be something that people might be looking for more kind of strength in here, momentum in Walmart. Walmart's kind of like Intel; it trades at like under twice revenue. Um, just cross $1 trillion. If they are able to add more value and more profitability, a company like that, it's the same as like Intel. If they can boost their profit margins, you have such a massive revenue base relative to their market cap that a company like that can really, generate, some other things here, which are one of the other stories, which is margins. Why do stocks move? Reason number two is margin expansion, or contraction. So I think we got to realize that that is a factor here with XLP. It's the very interesting emergence of Walmart as a major tech stock. XLRE, or e-commerce stock, whatever you want to call it, basically neutral here. But if we have downside in yields, this is something here that we could see this potentially squeeze to the upside. I was actually looking at WELL. This is an interesting long-term name, and also PLD, which is an e-commerce related real estate company. These are some names you might want to be looking at. But real estate here has that potential to move to the upside if yields move lower. Now, when we look at the utilities, also kind of just stuck here. And I think these guys do kind of trade a high multiple. They had a degree of this whole kind of data center exposure. They have some political risk with the things that, like, Trump was trying to do something with utility rates or something. So I think at this point, especially going into the midterm elections and stuff, these are things people might kind of view as having a little more risk than you would think otherwise. Um, you know, Healthcare XLV here might have the potential to finally break out. So I think this one is pretty tight. People should watch it. As we talked about when we talked about Amgen, we talked about Merck. We talked about the potential of all these names to kind of extend as they have. So this is what happens when you're not buying Nvidia. You're buying other large caps that are simply, these are not like, little companies. These are major companies, and they haven't really performed for years. And now money is moving to Amgen, it's moving to Merck, it's moving to Gilead, and it's not moving to Microsoft. That's kind of what's happening, I think, as people reallocate. So that's what I mean. It's not just people buying small caps or selling tech or something. It's a question of these kind of shifts from the old long duration to other stuff. And then XLY, in my view, also kind of just a false breakout, kind of stuck in this range. And again, I think people might see this kind of drifting. You have the problem of Amazon and Tesla, two mega caps that kind of dominate the whole thing. So those are the main things I'm going to talk about. I will see you guys next Monday for another State of the Market. Everyone has a great day. Don't forget about the economic data. Payrolls on Wednesday, CPI on Friday. Look at our article. Also, we have some of the earnings calendars in there. We put them on our social feed. Hope everyone has a great day. See you next week.